On January 29, 2025, the Federal Reserve held interest rates steady at a range between 4.25% and 4.5%, choosing not to cut despite widespread market anticipation. The decision was not presented as a crisis intervention or a dramatic shift in policy. It was framed as routine monitoring, a data-dependent pause in what had been a series of incremental adjustments. But beneath the measured language and the carefully constructed press conference answers, something structural was being revealed. The Federal Reserve was not guiding the economy toward a soft landing. It was managing the unraveling of a fiscal and monetary architecture that had been built on assumptions that no longer hold. The historical pattern is not new. In 1979, Paul Volcker took control of the Federal Reserve at a moment when inflation had become embedded in the psychology of the entire economy. Prices were rising not because of temporary supply shocks, but because households, businesses, and labor unions had come to expect continuous price increases. Volcker's response was to raise interest rates so high that the economy contracted violently. Unemployment spiked above 10%. Industries collapsed. The pain was deliberate, and it worked because the Fed proved it was willing to prioritize price stability over short-term growth. That credibility bought decades of low inflation expectations. But credibility is not permanent. It erodes the moment central banks hesitate, the moment they signal that pain thresholds have become too politically sensitive to enforce. The 2025 pause is not a repeat of Volcker's shock therapy. It is something quieter and more insidious. The Federal Reserve cut rates aggressively through late 2024, reducing the benchmark from over 5% down to the current range. Those cuts were justified by the belief that inflation was moderating and that the labor market was cooling enough to warrant relief. But inflation did not cooperate. Core services inflation remained sticky. Shelter costs, which represent the largest component of household budgets, continued to reset higher as lease renewals incorporated prior years of rent increases. Wage growth, while slowing, did not collapse. Consumer spending, particularly among higher-income households whose asset values had risen during the stock market rally, remained resilient. The economy, in other words, refused to cool on command. This is where the structural flaw becomes visible. The Federal Reserve operates with a two-part mandate: maximum employment and stable prices. In theory, these goals complement each other. In practice, they create a policy trap. If the Fed raises rates to crush inflation, it risks triggering a recession and mass unemployment. If it cuts rates to support employment, it risks reigniting inflation and losing the credibility that keeps long-term inflation expectations anchored. The only way to avoid the trap is if the economy cooperates by slowing just enough to bring inflation down without collapsing employment. That cooperation is not guaranteed. It is, in fact, historically rare. The chair of the Federal Reserve acknowledged during the press conference that the economy entered 2025 on solid footing. Growth was firm, the labor market had stabilized. Inflation was elevated but no longer accelerating. That combination is precisely what makes cutting rates dangerous. When an economy is running near full employment and fiscal policy is simultaneously loose, monetary easing acts as fuel on a fire that has not yet been extinguished. The chair used the phrase appropriate stance to describe current policy. That word, appropriate, is a signal. It means the Fed believes it has already done enough and is now waiting for the economy to prove that further cuts are necessary. It is a passive posture disguised as active monitoring. The fiscal backdrop makes the pause even more revealing. The United States is running a budget deficit of approximately 6% of GDP, while unemployment remains low and GDP growth remains positive. Historically, deficits of that magnitude occur during recessions or wars when tax revenues collapse and emergency spending surges. Running such a deficit during a period of relative economic strength is unprecedented in modern peacetime. It means the government is borrowing heavily not to stabilize a collapsing economy, but to fund ongoing obligations and political commitments that have become structurally embedded. The chair himself stated that the deficit is on an unsustainable path. He separated the level of debt from the trajectory, emphasizing that the problem is not the current stock of obligations, but the fact that borrowing continues to accelerate with no mechanism to reverse it. This fiscal trajectory creates a second trap. If the Federal Reserve cuts rates aggressively, it lowers the government's borrowing costs in the short term, which reduces the political urgency to address the deficit. That delay allows the debt stock to grow larger, which increases the eventual interest burden once rates normalize. But if the Fed keeps rates elevated, it increases the cost of servicing existing debt, which forces more borrowing just to pay interest, which accelerates the very trajectory the chair described as unsustainable. There is no clean exit. Every path forward involves either accepting higher inflation, accepting slower growth, or accepting a fiscal crisis that forces sudden and painful adjustments. The historical precedent most relevant here is not the United States in the 1970s, it is the United Kingdom in 2022. In September of that year, the British government announced a large package of unfunded tax cuts. Bond markets reacted immediately. Yields on long-term government debt spiked. Pension funds, which had used those bonds as collateral in leveraged positions, faced margin calls. The Bank of England was forced to intervene by purchasing government bonds to stabilize the market, even though inflation was still elevated. The intervention worked in the short term, but it revealed a deeper vulnerability. When fiscal policy becomes unmoored from revenue constraints, bond markets can impose discipline faster and more violently than any central bank. The United States has not faced that kind of bond market revolt, but the structural conditions that make it possible are being assembled quietly. The Federal Reserve's press conference included a question about whether the United States could experience a similar bond market crisis. The chair's response was calibrated to avoid panic. He stated that he did not see a near-term event on the horizon, but he also refused to dismiss the possibility entirely. He emphasized that the sooner fiscal adjustments are made, the better. That phrasing is significant. It implies that delay increases risk, not because of a specific trigger, but because the mathematics of compounding debt and rising interest expense create a dynamic that becomes harder to reverse over time. The longer the trajectory continues, the narrower the range of policy options becomes. The mechanism through which this unfolds is not dramatic, it is incremental. When a government borrows heavily, it issues bonds. Investors purchase those bonds based on their assessment of risk and return. If investors begin to doubt that the borrowing will ever stabilize, they demand higher yields to compensate for that risk. Higher yields increase the government's interest expense, which forces more borrowing, which reinforces the doubt, which pushes yields higher still. This feedback loop does not require a sudden collapse. It can occur gradually as yields drift higher over months and years, making refinancing more expensive and crowding out other spending priorities. The political system, which operates on election cycles and short-term incentives, is poorly equipped to respond to slow-moving crises that do not generate immediate headlines. The labor market adds another layer of complexity. The chair noted that risks to both inflation and employment have diminished, but he refused to rank which risk is now dominant. That refusal is itself a signal. It suggests that the Fed does not have a clear view of which direction the economy is tilting, which means policy is being set in a state of uncertainty. Uncertainty is manageable when the stakes are low. When the stakes are high, when inflation is still elevated and fiscal sustainability is in question, and bond markets are watching every decision, uncertainty becomes paralysis. The Fed is not aggressively cutting because it does not know whether cutting would stabilize the economy or destabilize inflation expectations. It is holding steady because holding steady is the safest option when both alternatives carry significant risks. The public perception of inflation compounds the challenge. Even when inflation slows, prices do not revert to prior levels. A household that saw grocery costs rise by 30% over 3 years does not experience relief when inflation falls from 8% to 3%. They experience a slower rate of pain. The psychological impact of that difference is profound. It erodes trust in institutions, it changes spending behavior, and it creates political pressure for relief that central banks cannot deliver without reigniting the very problem they are trying to solve. The chair acknowledged this dynamic during the press conference, noting that lower-income households have been forced to adjust spending while higher-income households continue to spend freely because their asset values have appreciated. That divergence is not a temporary imbalance. It is a structural feature of high-inflation environments. Asset owners benefit from rising nominal values. Wage earners without assets lose purchasing power faster than their incomes can adjust. The international comparison offers context. Japan spent decades with debt-to-GDP ratios far higher than the United States, yet bond yields remained low because domestic savings were high and inflation expectations were anchored. The United States does not have Japan's savings culture. It has persistent trade deficits, high consumption, and a reliance on foreign capital to fund government borrowing. That reliance makes the United States more vulnerable to shifts in investor sentiment. If global investors begin rotating away from U.S. assets, even modestly, the pressure on yields becomes structural rather than cyclical. The Federal Reserve can intervene in short-term markets, but it cannot indefinitely suppress long-term yields without creating distortions that eventually demand correction. The press conference ended without a clear signal of when cuts might resume. The chair emphasized that decisions would be made meeting by meeting based on incoming data. That framework is prudent in normal times, but these are not normal times. The economy is operating with simultaneous fiscal expansion, elevated inflation, tight labor markets, and rising geopolitical uncertainty. Each of those factors alone is manageable. Together, they create a configuration where small shocks can produce outsized reactions. A single disappointing inflation print can delay cuts indefinitely. A sudden softening in employment can force the Fed to ease despite inflation risks. A fiscal event, whether a government funding crisis or a bond market tremor, can force coordination between the central bank and the Treasury that blurs the line between monetary policy and fiscal financing. History suggests that nations at this juncture tend to choose the path of least immediate resistance. They delay painful adjustments. They hope that growth will outrun the debt. They rely on the assumption that credibility built over decades can be spent down without consequence. That assumption has failed repeatedly. It failed in Latin America in the 1980s, when debt crises forced austerity that destabilized entire political systems. It failed in Europe in the 2010s, when sovereign debt fears nearly fractured the Eurozone. It is failing now in nations where bond yields are spiking despite central bank assurances. The United States is not immune to this pattern. It is simply further along the curve, with more credibility to spend and more time before the reckoning arrives. But time is not infinite, and credibility, once lost, is extraordinarily difficult to rebuild. The Federal Reserve's decision to hold rates steady is not the end of a story. It is the beginning of a longer adjustment process that will unfold over years, not months. The question is not whether the system will adapt. The question is whether adaptation will occur through deliberate policy reform or through the kind of forced correction that leaves institutions weakened and populations disillusioned. The narrow path toward stability still exists. It requires fiscal discipline, structural reform, and a willingness to prioritize long-term stability over short-term political expediency. Whether that path will be taken remains uncertain. What is certain is that the alternative, the path of continued delay, leads to outcomes that no central bank can fully control.